All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options midweek update. Wanted to jump on, as we normally do here midweek, take a look at markets, where we stand here as we go into the second half of the week. We'll talk through some key markets that we track for overall market direction, and then we'll narrow it down to some of the individual names and some of the individual trades that are on our radar for the next couple of days. So let's go ahead and dive in. If you have any questions here along the way, feel free to type those in. For those of you that are watching live, you can always type in comments as we go. If you are watching the recording, feel free to post a comment on the YouTube page or Facebook. You can even email me directly to mike@netpicks.com. More than willing to connect and help out with any questions you might have. So let's start by talking through the daily chart of SPY. This is the S&P 500 ETF. We always like to start out with this chart. Even though we're not using this for actual entry and exit points, this is my go-to chart to get a feel for the overall pulse of this market. We've been talking for the last few weeks how overbought this market has been. Well, overbought has gotten even more overbought. I mean, it's just been amazing here to see some of these chart patterns, and I'll show you some of them in just a moment. But we are truly at historic extremes at this point. That does not mean this market can't head higher. We have seen overbought can continue to stay that way for an extended stretch. But what we're looking at here, if you're starting to look for new trades here the second half of this week, you will want to be cautious on the long side. If you have long trades on, that's fine. I have no problem with that. But initiating new long trades here, it's very, very difficult to do and actually put the numbers in your favor long term. We desperately need a pullback here in the near term, which would set us up for another wave potentially to the upside. We could very well see that going into the end of the year. We've talked about that as a potential outcome here in recent videos. But a pause here over the next 3 to 5 days would be much needed. If we can get that pullback, it's very tradable on the downside. We could very well see some nice short trades there for a quick pop to the downside before another wave higher. A lot of that will certainly depend on what they end up doing with the stimulus. If there is another round of stimulus released over the next couple of weeks, obviously there's been negotiations back and forth, but not much progress being made as of this point. So a lot will depend on what happens there. I've had a lot of questions on that from people asking, okay, Mike, what if we get another round of stimulus? Aren't we going to see this market rocket higher? You have to remember, we have gone higher now for the last number of months without any type of significant selling. There is a tremendous amount of good news already priced into this market. It's very well, we could very well see a sell the news type of event where the news is released. Maybe we get an initial pop to the upside, but we're so extended on so many of these key market names that we track. We're in need of a pullback. And let me talk about that in more detail once we get into the technicals. So on SPY, the all-time high is at 371.05. That happens to be the high of today's session earlier this morning. That is our new line in the sand on the upside. Should we continue to head higher here, we're in uncharted territory on the upside. All-time highs, we don't have any type of reference point from previous moves, right? So our focus shifts to the 0.50 and the 0.00 levels. So that has me looking at 371.50, 372, 372.50. Those are going to be areas on the upside that we'll want to track. No surprise here, at least earlier in the session, that we stalled out right at 371. It's a big round number. Everybody's long. Everybody knows the market's overbought. So if we're looking for potential areas that we could stall out at, it's those big round numbers that grab everybody's attention. Now, let's say if we do continue to get this selling this afternoon into tomorrow, where do we look for support? The first area that is very key for us is going to be at the 8-period exponential moving average. It's that pink line on this daily chart. So far, if we go back into late October, you can see that we have tested that 8 EMA a couple of different times. And every time that we've tested it, we have found support and it's led to another wave to the upside. If we're going to get anything going on the downside, we need to see that level break. It is currently sitting at 367.42. That is our first line in the sand that needs to be broken on the downside. It needs to be broken on a closing basis. Just breaking down below it intraday is not enough. I need to see price break below and close below that level. If it does, we've got a little air pocket down here Down to the 20 period moving averages, both the simple and the exponential, although those two green lines currently sitting right around 362.38. That would be our next area of support if we get anything going on the downside. Now, the concerning part on the upside is the volume has been completely lackluster. I mean, you can see here towards the bottom, we have seen, number one, going back to early November, we have seen the volume contract, but it has escalated over the past 4 or 5 trading days, where it's been another struggle to hit 50 million shares on a daily basis. To put some context around that, a normal range historically is going to be in that 70 to 100 million share range. We're nowhere close to that right now. Volume is non-existent. When that typically happens, you will see price action favor the upside. We have certainly seen that the last couple of weeks. If volume kicks back in, and we get a run towards the exits here, it could lead to a very quick move to the downside. That would be the ideal scenario for us. That would give us the volume number back up towards that 50-day average. The 50-day average, that yellow line, is around 72 million shares. I'd love to see us get back up towards that level, but it will take some selling to get back there. The ATR, the average true range, which is the yellow line down at the bottom, just showing the average daily range that we have on SPY. We had a very, very active stretch earlier in the fall, right? In September, into October, part of November, we had the ATR very elevated. In fact, we had a stretch there of a couple of months where the ATR was approaching 6 or above. That's a very active market. That's good range. That's ideal for an active trader. But now look what's happened since, middle of November. We have seen a steady decline, and now the ATR is approaching 4. There's a $4 average true range on SPY. As things start to contract, it becomes more difficult to stay active because it's just the markets are not near as active in both directions. We're just getting that one-way move higher. What I want to see happen on this ATR, I want to see it level out here a bit and then start to move back to the upside. Two-way price action is the ideal scenario for us as options traders. We want to see that back and forth movement. So I'm going to be watching the ATR closely here. I think we've got a little bit of a window here yet. Over the next week and a half before Christmas, I do think we have the potential there for some movement to work with. Once you start to get closer to Christmas and New Year's, we've got that stretch there. We've got that week where the volume tends to lighten up. Everybody's traveling. We'll see if everybody's traveling this year with the pandemic. But historically, we'll typically see lower volumes around the holidays. So we got a little bit of a window here that I want to watch these technical levels closely to see if we can get that much needed pullback. The VIX, if we take a look at VIX, still above 20, which is truly phenomenal. This is a historic move on the VIX. The VIX just takes a look at the volatility in the S&P. And if you take a look historically, you might get some stretches there where you get the VIX above 20 for normal situations, a couple weeks at a time. We are now going on months with the VIX above 20. So there's still some uncertainty out there, obviously, with all the unknowns with the pandemic and so forth. And, we still have some unknowns with the transfer of power coming up here early next year. So some of that's being priced in, but it's really amazing that the VIX continues to stay above 20, given that this market has been so one-directional on the upside. Truly fascinating to see. Looking at the internals, here's my concern with today's session. We do have some red on the screen, right? If I move my data box out of the way, I'll just get that out of there. So we do have some selling pressures starting to show up. You've got the Dow, the S&P, and the NASDAQ. They're lower. The Russell still higher. But when you take a look at these internals, the volume ratio today on both the New York Stock Exchange and the NASDAQ in the upper left-hand corner. On the NYSE, the volume ratio is at 1.36 to 1 positive, and the NASDAQ is right around 1 to 1. There's not any type of a mad rush to the exits at this point. The volume is not confirming the move. And when the volume doesn't confirm the move, that's typically when you start to see chop and you start to see false breaks. What I want to see happen here this afternoon and into tomorrow, if we're truly going to get some selling to develop with some follow-through potential, I want to see these volume ratios at -2, -3 to 1 at a minimum. That would start to show there is volume leaning on the downside. We don't have that as of yet. The advanced decline line on the NASDAQ. The advanced decline line is only at minus 184. This is not across the board selling in all of the NASDAQ names. We need to see that. I want to see this advanced decline line at minus 1,000, minus 1,500 at a minimum. That would indicate more across the board selling, and that would lead to more staying power. If we're going to get more follow through on the downside, I want to see every sector, every area of this market participate. And right now, the NASDAQ, it's lower, but it's not across the board selling. And the same goes for the NYSE. The advanced decline line is actually positive, plus 480. There's actually more names in the New York Stock Exchange that are positive on the session than negative. This is not across the board selling at all. And that's why for me, when I come in and take a look at where we stand midday, like we're doing here today, I love to look at the internals. If I take a look strictly at the index products, you would think, hey, we've got some decent selling going on here. When you take a look at the internals, they're painting a different picture. We still have a lot of work to go here if we're going to get any type of follow through on the downside. We haven't had any type of extreme on the tick in the lower left-hand corner. The tick takes a look at how many stocks are trading on an uptick versus how many stocks are trading on a downtick. What I want to see are extremes. I want to see plus 1,000 tick readings on the upside. That would indicate buy programs kicking in. And then I'd love to see minus 1,000 tick readings on the downside. That would indicate a sell program kicking in. We had one extreme right at the open this morning. We had one plus 1,000 tick reading right at the open. Haven't had any type of minus 1,000 tick reading. We've had very few sell programs the last couple of weeks. But as we're speaking here, we are starting to see some selling pressure. It looks like SPY is going to go down and try to make a new low on the session. So, I mean, a lot can happen over the next few hours. What I want to see come end of the day today, want to come in, see these volume ratios turn negative. I would love to see the advanced decline lines turn negative. And then ideally, if we can get a couple of minus 1,000 tick readings, that would really open up things over the next couple of days for a nice, healthy pullback. Now, with me saying that, a lot of times people hear me talk about that, and I get the comment that, Mike, you sound like a perma bear. You sound like you're that doomsday outlook, and that's not what I'm saying here at all. I still think the market has another push to the upside going into the end of the year. But in the very near term, the next 3 to 5 days, we definitely are looking for a tradable pullback. So based on what I'm seeing here, again, I want to be more cautious on the upside. If you've got long trades on, that's fine. Continue to move stops up. Try to lock in some profit along the way. That's okay. But as far as new trades go, I am looking at the moment for more neutral to bearish type positions that would benefit from that pullback should we get it. I'm not necessarily looking for long puts across the board because long puts are very time sensitive. At the minute you buy an option, in this case a put, that clock is ticking. You need that move to the downside pretty quickly. Until we start to see some of these internals break down and we start to see the volume kick back in, we could very well see more chop and more consolidation first. By coming in and using a credit spread, we can start to put the time decay in our favor. We can start to stack some things in our favor just in case we don't get that big move lower. If we do get the move lower, that's great. The credit spread can still potentially make money from that, right? For selling a call spread, it is a neutral to bearish position. If we start to see price confirm, if we start to see volume confirm, we can shift our focus very, very quickly from the credit spreads to more long puts at that point. So it's all about taking what the market's giving us. And let me show you some of the key markets that I'm tracking for new setups over the next few days. Let's start out with SPY. Let's go from the daily chart to now looking at the 195-minute chart. I've had a few questions come in on this one here the last week. What are my favorite time frames to trade? I love the 195-minute. It just splits the day up into two. You'll get 2 candles a day. I also like the 130-minute. I have found both of those time frames to be pretty darn reliable. You start to go down below 130 minutes. You start to go down to an hourly chart, for example. The tricky part there is that chart type is more prone to getting caught up in chop. What I found is the 130 and the 195-minute, they will start to filter out some of that chop. So those are my favorite time frames to look at. Those are the ones that I use most often. Here on SPY, we've talked about that pulse indicator quite a bit here recently. It's the red and yellow histogram down at the bottom that recently has given us 3 yellow bars on the upside. That indicates that price is at an overbought extreme. We're between a 1 and a 2 standard deviation move on the upside. Doesn't mean that SPY can't move higher. It just means it's not statistically probable. When you start to see those yellow bars plot, if you go back in time and take a look, anytime that we get those yellow bars to plot, it has led to a reversal in the very near future. Doesn't guarantee it's going to happen here. It's a very reliable pattern that we have seen historically. One of the ways that we took advantage of this is yesterday afternoon, we put on what we call our overnight pop trade. This is one that we've talked about here in these live sessions over the past month or so. These are trades that are looking to take advantage of movement going into options expiration. SPY is unique in that it has Monday, Wednesday, and Friday expirations. Yesterday afternoon, we came in and we looked to put on a trade that expires this afternoon. These are trades that we're looking to take for 24 hours or less. What we did is we came in and we sold a call spread. Again, using the December 9 options, the ones that expire today. So we came in, we sold the 371, 373 call spread. All that means is I'm selling the 371 call to open and I am buying the 373 call to open at the same time. We put this trade on yesterday afternoon, got filled at 50 cents. We collected $50 per spread. It tied up $150 of our capital per spread to put on the trade. So we're right around risk 3 to make 1. Very typical range for us. With most credit spreads, we're going to be in that risk 2 or 3 to make 1 range. Well, anytime that I put on a credit spread, whatever I collect to put that trade on is my maximum profit. So in this case, we had 50 cents of of profit potential. That was our max profit on the trade. I was targeting between 50 and 75% of that max profit. So I was looking to close this trade out for between 12 and 25 cents, anywhere inside of that range. You can see the price down at the bottom. It's currently traded for 5 cents mid price. We essentially have the full profit had we held on. I closed this trade out earlier in the session for 12 cents. That gave me 75% of my max profit. Why didn't I hold? If I held right into the close this afternoon, I could have potentially kept the entire 50 cents, taken the full profit. Here's the problem with that. We've seen it here lately. We have had very little follow through on the downside. You get these days where we're lower earlier in the session. What has it led to? You'll typically see that bounce off of the lows going into the afternoon. If that happens here and you hold, if we see this reversal to the upside, we could go from a nice profit to a loss almost immediately. These options are very, very active this close to expiration. Instead, I would rather take the profit, close out of the trade for 12 cents like we did earlier. That frees up the capital and allows us to move on to the next trade. And then more importantly, it just frees up the rest of your day. You don't have to sit there and watch every little tick back and forth, just making sure that you can book the entire profit. I don't like that approach personally. I do have some traders that will take that approach. That's fine. I would just rather book the profit and move on with my day. So that is exactly what we did and booked the profit there on SPY. We did actually take a second trade with our ETF service yesterday afternoon. And with that one, instead of just selling the call spread, we actually used the iron condor. All an iron condor is selling an out of the money call spread and an out of the money put spread at the same time. Okay, we're doing both sides of the trade. It's a neutral trade where I'm looking for the stock price to stay in between the strike prices of the options that I sold. On this trade here, we sold the 372, 374 call spread. And at the same time, we sold the 368, 366 put spread. I'm short the 372 call and I'm short the 368 put. I want price to stay in between that range. As long as it does, we can make money on the trade. We collected here yesterday 48 cents per spread. We collected $48 per spread on the position. It tied up $152 of our capital to put the trade on. We ended up closing the trade out here earlier today. Okay, I closed it out for 16 cents or $16 per spread. The reason I closed it out, again, much like I just talked about over on the short call spread on SPY. I don't want to hold all the way up to expiration this afternoon because things can change in a hurry. If we do get a big directional move this afternoon, I don't want to have this thing go from a nice profit to a loss. I'd rather take the partial profit, free up the capital for the next trade, and then also freeing up the rest of my day so I don't have to sit there and manage these trades closely. So you can see here, obviously, after we close it out this morning, price has reversed back. The price of the spread is back up around 30 cents. It would still be a profitable trade had you held, but obviously, it's nowhere near that 16-cent price that we got filled at earlier to close out of the position. So anytime that you're using these credit spreads into expiration, I highly recommend closing them out before expiration, taking the partial profit. I got burned so many times in years past where I used to hold credit spreads all the way to expiration every time. And I can't tell you how many times it would happen where I've got a trade that's working great in my favor. We get it right up to expiration and I hold, trying to let the thing expire worthless. That way I can keep the entire profit. And then I get burned in the last couple of days before expiration, or in this case, the last few hours before expiration. So had to learn that lesson the hard way, unfortunately. And I prefer these days to take the partial profit. So now that those trades are closed out, let's go back over to the 195-minute chart. What am I looking at here for a potential new trade for the next couple of days on out to the next couple of weeks? We're still overbought. Today's selling does not change a thing. I mean, SPY is down $1. It's a drop in the bucket compared to what we've seen over the past few months. We're still very, very overbought. If you wanted to come in and sell another call spread, I'd be completely open to that. Let's go over to the trade page. Let's go back to Thinkorswim. We are going to take a look at another trade here, but using a different expiration cycle. Shrink all this stuff down so it's easier to see. What I'm looking at here is more of a true swing trade. I'm not looking for an overnight pop trade here. I'm looking for a trade that I can potentially hold for a period of days or even a few weeks. I could take a look at some of these additional weekly options that I have available. All of these option cycles in yellow represent the weekly options. You can also go all the way out to January with 37 days left. If you go out to January, it's just going to require you to hold the trade longer. Don't have a problem with it. Okay, with this market so overbought, could very well see us pull back and maybe not rocket ship higher. Maybe we just kind of chop sideways at that point going into the end of the year. If that's your outlook, I have no problem using the January options. What I'm going to do here is let's go ahead and take a look. Let's take a look at the December 31st options. These are actually the quarterly options. So they have 22 days left to expiration. If we go ahead and open those up, let's go out to the 373 call. I'm going to go to the out of the money call options. I'm looking to sell an out of the money call spread to give myself a neutral to bearish position. I would right click on the 373 calls, go to sell, go to vertical. Down at the bottom, it pops up an order. By default, I'm selling the 373 call and I'm buying the 374 call at the same time. There's a $1 difference between those strikes. What I like to do on a spread is ideally, I like to collect between 30 and 40% of the width of the strikes. There's a $1 difference between the strikes. This trade is actually pricing at around 38 or 39 cents. So it does meet my criteria. This trade would be doable here as is. What I'm going to do is take it one step further. Instead of buying the 374 call, I'm going to stretch it out to 375. Why am I doing that? Notice what it does to my credit. I'm able to collect 73 cents. So it gives me a larger credit. I still get a decent reward to risk ratio. I'm risking $127 to make 73. That's very, very good for a credit spread. It also gives me 5 ways of making money on the position. I make money if SPY moves up, down, or sideways. It does not matter as long as price stays below 373, 373.73 to be exact. I make money. Well, the price currently is sitting at 368.50. This gives me a $5 cushion where I can be dead wrong. SPY can continue to move to the upside and I'm still okay. The only move that hurts me is a big move higher, which I'm not expecting because the market's already overbought. We also make money if volatility decreases, and we make money if time decay adds up, which we know time decay will add up every single day. That's a given. The volatility aspect, I got some questions on this here lately. What if the market does pull back? Normally, when the market sells off, you see volatility expand. What if that happens? Well, we have 5 ways of making money on this spread. I don't need all 5 to line up in my favor at the same time. Okay. If we see a move to the downside, that's going to be enough to offset any type of movement and volatility that we see. The time decay is still helping me, and the directional movement is still working in my favor. Right. So I don't need volatility to contract. If it does, great. That's an added bonus, but it's not required in order for us to make money. Right. So this trade definitely meeting our criteria. Let's say we do get filled at 73 cents. Where's my target zone on this trade? Like I mentioned a few moments ago, my target zone on a credit spread is always between 50 and 75% of my max profit. So if I can buy this thing back for between 18 and 36 cents, that would allow me to keep between 50 and 75% of that max profit. So I would start my closing order at 18 cents. See if I can get filled there and book the nice profit. So that's definitely a trade on the radar for the next couple of days. I personally don't like to place credit spreads midday like this. I will typically wait till the last hour of the session. That way I can come in, see if there's any intraday head fakes, see if there's any false breakouts, maybe adjust the trade going into the close. We also typically see a bigger pop in volume towards the end of the day. That makes it easier to get fills on trades. So everything I've talked about so far on SPY holds true. I just wouldn't place a trade until this afternoon during that last hour of the session. QQQ, the NASDAQ ETF. The NASDAQ is the weak name out of the bunch here today. We're certainly seeing some selling here going into this afternoon. If you take a look at the 195-minute chart, we are overbought. The pulse indicator has given us 4 yellow bars here. Notice price up top. We're at a very key point because price is now starting to break below the 8-period exponential moving average. That's that red and blue line. If that level breaks, like I talked about earlier on the daily chart, if we start to see that level break, that could open things up a little bit on the downside. Now, why am I not looking at a long put here? Well, first, price action, it's great to see it lower today, but we've seen very little follow through on the downside at all. What I want to do is wait to see price action confirm. And what would confirm for me down at the bottom is if this trend strength histogram breaks below the 0 line. Right now it's above 0. It's blue, indicating bullish momentum is still in place. What I need to see happen here for me to jump more aggressively on the downside, I would need to see a red trend strength histogram. We don't have that right now. But selling a call spread, just like we did on SPY, is definitely a strategy that we can use here. Why would I be open to selling a credit spread? Because now the time decay is working in my favor. If I get in a little bit early, if we start to see chop instead of a true pullback, I can still make money with a call credit spread. So let's just stick with those December 31st options, the ones that the ones that we were just talking about over on SPY. Let's continue to use those here on QQQ. I am going to go out to the 310 call. I'm going out to the 310 call, by the way, because that has a 65% chance of closing out of the money. That's typically where I start out with if I'm using a credit spread. So I'm going to right click on those, go to sell, go to vertical. Just like we did on SPY, I'm going to use a $2 wide spread. Instead of using the 310, 311 call spread, I am going to use the 310, 312. Stretch it out to a $2 wide spread there. And sorry, guys, we got this market moving here, so I'm trying to get some orders placed. Bear with me a second. I'm still around. Okay. All right. Good. All right. Sorry about the delay, guys. Markets are down near the lows and wanted to make sure that I get some orders placed. All right. So on QQQ, the 310, 312 call spread, all that means is I'm selling the 310 call and I'm buying the 312 call at the same time. It gives me a risk defined trade. I'm collecting around 70 cents. We'll just call it 70 cents mid price here. If I get filled at 70 cents, I would be risking 130 to make 70. Right around risk 2 to make 1, actually slightly better than that. We give ourselves 5 ways of making money on the position. I make money if the stock moves up, down, or sideways. Doesn't matter. As long as price stays below 310.70, I'm okay. Price is down near 304. We've got over $6 of a cushion here that we can be dead wrong on direction and still make money. The only move that hurts me is a big move above 310.70, which we're not expecting because, again, the pulse indicator is very, very overbought. We also make money as time decay adds up and if volatility decreases. So now I give myself 5 ways of making money on the position. The 70 cents that I collect is the most I can make on the trade. That's my max profit potential. I'm going to look to close the trade out when I can keep between 50 and 75% of that number. So if I can close this thing out, if we can close it out for around 17 to 35 cents, anywhere inside of that range, that would be an acceptable profit potential on the trade. So that's another neutral to bearish position that I'm looking at for the next couple of days. IWM, the Russell 2000 ETF, has been another just dynamite performer on the upside. I mean, this has just been an extreme move higher. It is very overbought. You can see the pulse indicator down at the bottom, plotting yellow. This is another one, just like the other index products that we just talked through,